The stock market is a lie, and it should have crashed months ago. Every single indicator is screaming red, consumers are buried under a mountain of debt, and the economy is showing deep, undeniable cracks. Yet, the market continues its phantom climb, and I am going to pull back the curtain and show you exactly why. Because once you understand the invisible hand that is quietly propping up this entire charade, you will see not only why the crash has been delayed, but why this very delay is the most treacherous part of it all. Stay with me until the end, because the final piece of this puzzle will change how you see the world of finance forever. I'm Seth, and after decades in the trenches of fintech and banking, even with a finance degree and an MBA, I used to stare at the market charts and think none of this makes any logical sense. Headlines were shouting about recession, inflation was a runaway train, but the market just kept drifting higher, as if in a dream. Then I uncovered something, a hidden mechanism that almost nobody talks about. Markets don't crash when things look bad on the surface. They crash when the forces holding everything together finally snap. And once you can identify those forces, everything that is happening today becomes frighteningly predictable. So, let's dissect this together. First, the warning signs are not just whispering, they are roaring. Legendary investor Warren Buffett is sitting on a massive pile of cash for a reason. One of his most trusted market valuation tools, a guideline most people have never even heard of, is telling him to stay on the sidelines. Buffett looks at the total market capitalization of all public companies divided by the U.S. gross domestic product. Right now, the market cap of all U.S. public companies is a staggering $66 trillion. The U.S. GDP is about $30 trillion. Divide 66 by 30, and you get 220%. Here is the truly terrifying part. Anything over 100% is considered dangerously overvalued. To give you some perspective, before the dot-com bubble burst in 1999, that ratio was 115%, not 200%, not 150%, 115%, and the market still imploded by over 60%. That fact alone should send a shiver down your spine. If you want to understand these hidden market forces and protect your wealth before it's too late, subscribe to the Next Gen Mentors right now and hit the notification bell. We provide the insights you won't find anywhere else. Now let's talk about something else no one is paying attention to. Do PE ratios even matter anymore? Apparently not. And it is not just how high they are, it is something far more sinister. Historically, S&P 500 companies have an average PE ratio around 15 to 16. Today, it is hovering between 25 and 28, already in the danger zone. But that is not the real story. The real story is about the companies that are dragging the S&P 500 upwards, and this is where it gets truly unsettling. Nvidia's PE ratio is between 53 and 55. A normal, stable mega-cap company should be around 20 to 25. Yes, tech companies run a little hotter, but not over 200% hotter. Amazon's PE ratio is 35 to 37, and Microsoft's is 35 to 40. And the one that will truly shock you, Tesla's PE ratio is a mind-boggling 286. This means investors are willingly paying $30, $40, or even $50 for a single dollar in earnings. Would you pay $50 for a $1 candy bar? It sounds insane, but people are still buying. And here is something that should make everyone nervous. Before the dot-com crash, S&P 500 PE ratios were running between 29 and 32, roughly the same as they are today. All of these signs are screaming that a market crash is long overdue, yet it has not happened. So let's look at the hidden forces holding this fragile market up. Even with all the indicators flashing red, high inflation, rising consumer debt, a slowing job market with increasing layoffs, corporate earnings slowing down, elevated PE ratios, and a grossly overvalued market, the house of cards still stands. Why? Here is the part that most people miss. It is because two powerful forces are working in the shadows to keep it all from collapsing. Force number one, the government is quietly pumping stimulus into the economy. Officially, the stimulus checks ended years ago, but look closer. The government is still injecting money into the system in ways the average person never sees. Expanded credit programs, quietly increased government spending, and corporate support mechanisms like tax cuts and what some call corporate welfare. It is stimulus in a clever disguise, because they do not want you to see it. Take government spending. The government collects about $5 trillion in tax revenue each year, but it spends about $7 trillion. Much of that $7 trillion finds its way into corporate profits and employee paychecks. Consumers then use that money to buy things, which props up corporate earnings. So, this massive government overspending is artificially inflating our economy, but with $38 trillion in national debt and annual interest payments of more than $1 trillion, how long can the government keep this up before the day of reckoning arrives? Likely not much longer. And here's the crazy part. This is not even the main force at play. Force number 2 is the devaluation of the dollar and inflation. The current administration wants a weaker dollar to make U.S. exports cheaper. That is no secret. But other, less obvious factors are also eroding the dollar's value. Countries like China and the BRICS nations are pushing to settle international trade in currencies other than the dollar, and this is happening at an accelerating rate, reducing global demand for the dollar. Also, U.S. treasuries are no longer seen as the risk-free safe haven they once were, which further weakens the dollar. When demand for the dollar falls, its value falls, and this is made worse by the government flooding the system with more dollars. It is simple supply and demand. More dollars chasing the same amount of goods and services means prices go up, and the value of each dollar goes down. So every dollar you have is silently bleeding value. But how does this prop up the stock market? It is a toxic cocktail. Government spending supports consumer spending and fuels inflation. The dollar loses value, companies raise their prices, and when prices rise, corporate earnings rise, not because of innovation or productivity, but simply because the dollar is worth less. This is how companies can report record earnings even when they are selling fewer products. It is not real growth. It is inflation disguised as growth. But Wall Street sees those higher earnings and rewards companies with higher valuations. And here is something else very few people understand. If you borrow money to buy assets like stocks, and inflation rises, you win twice. Your debt becomes cheaper because you pay it back with less valuable dollars, and your assets increase in value. This is why the top 10% of the population, who own almost 90% of all stocks, get richer, while the bottom 90% see their cost of living skyrocket. Now let's look at the year 2025 in review, and what is coming in 2026. 2025 has been a year of turbulence, despite the S&P. P500 showing a 17% gain, we saw a mid-year dip caused by unexpected Federal Reserve actions, and as of December, the market is trading at a 3% discount to fair value, with small cap and value stocks showing signs of life. Consumer debt has continued to climb, and delinquencies are on the rise, a clear sign of an affordability crisis. Inflation has remained stubborn, hovering around 3%, and the labor market is finally showing cracks, with unemployment rising to a 4-year high of 4.6% in November. Looking ahead to 2026, the outlook is murky at best. Economists are predicting a stagflation-light scenario, with GDP growth expected to be below the typical 2% trend. Some analysts predict the S&P 500 could reach 7,800, a 14% gain, while others see a more modest 4% increase, and some even predict a downturn. The Federal Reserve has signaled more rate cuts for 2026. But with a deeply indebted consumer and persistent inflation, lower rates may not be the magic bullet everyone is hoping for. The crash has not been canceled, it has only been cued, and the longer the delay, the bigger the eventual collapse will be. This is not about spreading fear. It is about understanding the cycle so you can protect yourself, stay rational, and make smarter decisions when everyone else is panicking. Let's build on your momentum. I have got another great video called Do This Every Day and It's Impossible to Stay Poor. It is on the screen now, so click it and I will see you there. If this breakdown helped you find clarity in the chaos, subscribe and like. We publish fresh, practical, no-nonsense content weekly to help you grow and protect your wealth. And if you want to get control of your finances, I have put a link to a financial fundamentals bundle in the description that may help. Check it out.